It's all about playing that game of what makes sense with regards to the returns and how much risk are you willing to take to try to get those returns.
Welcome to the Freedom Point Real Estate Podcast, where we talk about creating more time freedom through passive real estate investing. Passive investing in real estate challenges conventional investment wisdom. We are passionate about learning and sharing resources with others who are ready to transform their investing mindset. Quick disclaimer as always, I am not a CPA, I am not an attorney or a financial advisor. This is not financial advice, not telling you or anyone else what to do. The views and opinions expressed in these podcasts are provided for education and informational purposes only and are not necessarily the views of my employer, ADP. I'm glad you're here. Now let's dig in.
Hello, listeners, and welcome to the show Freedom Point Real Estate Podcast. Thanks for joining us today. My name is Drew McWilliams, and I will be your host. Today, our guest is Bikran Sandhu, who is the COO, CFO, and co-founder of Rise 48 Equity and Rise 48 Communities. Bikran's main responsibilities as COO includes overseeing underwriting, asset management, and investor relations. Bikran's main responsibilities as CFO include overseeing accounting, finance, and treasury at Rise 48 Equity and Rise 48 Communities. He resides in Scottsdale, Arizona with his wife. Bikran has a professional background in audit and assurance services where he worked at PwC and audited Fortune 100 companies as well as pre-IPO companies. Bikran also has a professional background in management consulting services related in compliance, risk advisory, and transactional accounting advisory services for Fortune 500 companies. Bikran, welcome to the show.
Thanks for having me, Drew. Really appreciate being on here.
Absolutely. I love, first of all, your background is really, really deep. So I appreciate you being on the show. I think this is going to add a wealth of information. I love your company, Rise 48. Personally, I want our listeners to know that I'm invested in 4 different Rise 48 investments. So I'm a big believer in what you guys do, and I'm really excited to tell the listeners a little bit more about kind of, how do we analyze a deal? And that's really what you mainly oversee. So before we jump right into questions, I would love to just open up and learn a little bit more about maybe what you're working on today, other than the background that I gave to start out.
Of course. Yeah. No, we started Rise 48 Equity in the beginning of 2020. And at the time, our goal was just to buy good quality assets in the Phoenix metro and run those assets, execute our business plan and essentially get out of those deals in about 3 to 5 years. And slowly, as we've kind of built out our platform in Phoenix and now have kind of been duplicating that platform in Dallas, we've slowly kind of grown the company as well. So my role has gone from just mainly underwriting deals and doing asset management to now kind of overseeing the back office side and kind of overseeing individuals that are now essentially running the company. So right now, the biggest thing that we're developing and building on is just the infrastructure so that we can continue buying more and more deals, being able to effectively asset manage those deals and execute our business plan and keep those deals running smoothly. So, we're in a bit of a downturn right now with regards to the economy. So asset management operations are really critical. And, we're investing money into the company to make sure that, the things that really matter, which is the property operations, don't fall down just because we're buying more and more deals and, we don't have the infrastructure there to kind of back it up. So that's been the main focus that Zach and I, who's the other co-founder, along with Robert Shevchik, that's the main things that we're looking at and kind of building out as we develop a footprint in Dallas.
Yeah, I love that. And I'm equally invested in both your Phoenix and your Dallas markets with you guys. So asset management, unpack that a little bit. Maybe some of our listeners don't really know what that term means. Would you mind kind of defining that a little bit more?
Yeah, of course. So, when we buy a deal, Drew, the main things are, we have a business plan that we want to execute over a specific time horizon. From an operations perspective, it's critical for the on-site staff and the regionals and the property management side to make sure that the property is humming along. Operationally, we're taking care of any maintenance issues, we're keeping the units occupied, and anything that's being turned over, meaning that units are like tenants are leaving and new tenants are coming in, that the units are being renovated and and being appropriately turned so that they're ready for new tenants. From an asset management side, you're really kind of looking at the numbers of the whole thing. So, you underwrite the deal on the front end, and you're kind of marking it against your pro forma as you're going on a monthly or a quarterly basis. Giving that one responsibility just to the operations team is too much work, because they're having to look at the 30,000 foot view, 20,000 foot view, all the way down to the ground level. We want, operations to focus on the ground level to make sure that the strategy is being executed. But on the asset management side, we want to look at the 30,000 foot view to see, okay, well, we have a 60-month trajectory. How are we tracking against that trajectory? So, in our business plan, we focus very heavily on in-unit renovations. We're spending close to $16,000, $17,000 in each unit to do the renovation and really kind of increase the rents. So from a numbers perspective, we want to make sure that we are renovating on a timely basis, and we are increasing the rents on a timely basis and efficiently enough where, it's meeting or beating our pro formas. And if it's not meeting or beating our pro formas, how can we pivot the business plan a little bit so that we're not spending the same amount and getting a lower return for investors? So that's where asset management comes in. You're looking at the analytics, you're looking at a 30,000 foot view of the entire project as a whole, and you're kind of making sure that, as we hum along at the property level, that we don't take our eye off the ball overall at the project, so that it's not, falling apart because we're just focused on leasing or we're focusing on a new asset.
Perfect. That's awesome. I appreciate you kind of defining that and kind of walking through that. So normally in these podcasts, I'm very organic and I let the conversation, kind of go wherever the guest leads.
Yeah.
I definitely have pre-structured questions today, not going to lie. So there is just so much to learn from you that I've gotten to learn over the last year, that maybe some terms that would be helpful for our audience who might be new into this space and into private real estate investing for passive income. Another term that I would love to kind of walk through is full cycle, right? A lot of folks might not understand, what does full cycle deal mean?
Yeah.
And let's walk through kind of what that experience has been for you and your company. Because I know a lot of investors come to me, and even if they know the term, full cycle, they say, well, how many full cycle deals have you gone through? And you're one of the few operators that have gone through that full cycle deal. So if you can kind of unpack, what does that mean, and what has that experience been like for you and your company going through a couple of these?
Of course. No, happy to do that, Drew. So, at Rise 48 Equity, we've acquired 45 deals to date, and we've gone quote unquote full cycle on 11 deals. What full cycle means is that we've essentially bought the deal, we've executed our business plan, and we've sold the property in a set time frame to another buyer, so that we can get returns to our investors and the project as a whole. So full cycle essentially means we've completed, steps A through Z on the entire project, everything from acquisition all the way through disposition and giving back investors their capital and their profits. And when you mentioned, you investors want to know who has gone full cycle or not, it's very critical, because on the front end, it's very easy to underwrite heavy pro formas on, how rents are going to go, how expenses are going to go. But operationally and from an asset management perspective, it's essential to make sure that you've, actually executed the business plan, or you're actually performing to target. So, in a downturn economy, or in a lower end economy that's, that's going and kind of recovering, it's harder to do those things, because it's more difficult to get more tenants in, difficult to get more pro forma rents in. But being able to execute the business plan and renovate these units, rebrand the exterior, take care of deferred maintenance, and then being able to sell these deals is very critical. So when investors hear, some sponsors have gone full cycle, that means that, hey, on the front end they've said they're going to do this, and on the back end they've actually done this. So that's what full cycle essentially means.
Yeah, that's perfect. And one of the things that I love investing with you guys personally is I feel that you share the same mindset that I do, as I under promise and over deliver. So I know a lot of investments, you guys typically target 5 years is kind of the projection. Are you allowed to speak on kind of what has your track record been in the past?
Yeah, I mean, I can tell you from like a project level perspective, and in terms of all our underwritings, we've always assumed a 5-year horizon. We never assume we're gonna, double an investor's money in 1 year or something. We've never promised that. We never guarantee that. We always tell investors, hey, the investment is a risk, so you are taking a risk investing. But in terms of our projections and if we can execute the business plan, run the property efficiently, we're projecting around a 5-year hold period. And in that 5-year hold period, at a project level, it's around I would say 16 to 18% IRR. That's before any investor splits, before any prefs or anything. So those all vary deal by deal. But in terms of our targeting, we're targeting between 16 to 18% IRR at a project level for the deal to kind of make sense for us to kind of pursue. Some deals are a little bit more juicier than that, depending on the market. But with the higher returns, you're going to be taking on more risk, right? So if a deal is closer to say 19, 20% IRR, maybe the deal is located in a little bit worse area than another deal. So it's all about playing that game of what makes sense with regards to the returns and how much risk are you willing to take to try to get those returns. So that's typically what we're trying to target on our end when we're looking at the deals.
Yeah, perfect. So in evaluating deals, right? How do you decide what is a good deal versus not a good deal? And a part two to that question are there certain things that are just non-negotiable for you that every deal must have?
Yeah, it's a great question. So with regards to, looking at what's important and not important, obviously unit mixes are very important, right? So you don't want to buy a, completely a building pretty much that only has studios and one bedrooms where you primarily have families residing. So, if you look at our portfolio, and we have a deal called Rise at the Retreat, which is about a mile away from ASU. Now that location is great for studios and one bedrooms because you have students living there, you have single parents living there who are going to graduate school. That type of building does not make sense where you primarily have families, right? So you look at locations in West Glendale near Avondale or Goodyear, we have buildings that are primarily 2-bedroom, 2-bath, because that's where, you have more families living in those locations. So, looking at the unit mix and looking at it from a location perspective is important. You don't want to get stuck, being the odd man out with regards to the type of buildings you offer or the units that you offer. The other thing that's really critical, for us is the crime ratings in those locations. So, we have bought deals that are in quote unquote Class C locations, I would say that, we think we're going to do a good job on those, but in a downturn, those Class C locations tend to become a little bit more exasperated. So, looking at the crime ratings and the property rating in general is pretty important for us. So if we find a deal, and we use a website called bestplaces.net that we can put in the zip code, see what the crime ratings are. And if a deal, is kind of outside the metrics of what we are generally comfortable with, we'll try to do a little bit more digging on, like the crime data at the site itself. We'll use LexisNexis to see what type of crime reports have been submitted. Have there been any assaults or any major issues at the property? If there have, we typically would walk away. But when it comes to, the crime and the location, that's number one and number two things that we look at. Next up, on the non-negotiables, obviously, location is critical. We don't want to end up in a bad area. Even with a 2000 build, you don't want to end up in like a Class C minus area because that deal's not going to do well. And what we want to target is a Class B, Class C property in like a Class C plus, Class B area, depending on the location and depending on the market. And the other the other big non-negotiable that we have is, we're not going to stretch our pro forma to try to meet the guidelines that the brokers say. So for instance, if a property is, say it's collecting $300,000 to $400,000 of rental income every single month, but then it's writing off meaning it can't collect close to $70,000 of the rent every single month. It's not really collecting $300,000 every month. It's only collecting $230,000 every single month. So if the broker, is coming in and say, well, you can just burn off the loss to lease, or you can burn off the bad debt and you can collect $300,000 a month, we look at historicals. If every single month the property is only collecting 250 to 260, we're not going to come in and assume we're going to start collecting 300,000 onwards. Like it doesn't make sense. So we'll try to burn it off as much as we can. But if it doesn't make sense, the location's bad, there's too much bad debt, we'll typically not pursue that type of deal. So a non-negotiable for us is, if the property has very heavy bad debt expense every single month, it's probably going to be very management intensive heavy. And so we'll probably shy away from those types of assets.
Yeah, I love that you don't force a deal, right? Just because you need to have a certain quota every certain year. So I love that. How many deals do you typically look through or sift through to find one to acquire?
Yeah, our strike rate's about 3%, 2.5 to 3%.
3%.
Yeah.
Wow.
So
Okay.
we'll underwrite. No, well, partly it's because we underwrite every single deal that comes across our table that meets our criteria, right? So if it's a 1980s or newer and it's at least 150 to 200 units or more, and on CoStar it's rating at least a 3 or a higher, we'll look at the deal and underwrite it and provide feedback to the broker, which we think is very critical. We don't just shy away from a deal or don't underwrite it if it meets those metrics, but we have like a different feeling for it or something, right? If most of the deals that we're underwriting were about 18 to 30% below what the seller is asking. So if the seller is asking for, close to 30 million on a deal, we're probably getting to around 25, 26 million. And sometimes those deals, those numbers work, the seller will come down or we'll be able to execute on a transaction number that makes sense. But majority of the times, the expectations are just so far apart that it doesn't make sense to pursue the deal. And that's why we pursue the numbers so much, is because if we can underwrite enough, it's just finding a needle in a haystack. It's a volume game. So we can find that deal in every 30, 40 deals.
Yeah, that's great. No, thank you for breaking that down.
Yeah.
So next question, it's going to be either personally or professionally how you answer this one. What is one purchase or investment that you've made that you since regretted?
Yeah, I think that's a good question. I would say when we first got started in multifamily, my wife and I, we invested passively with a sponsor in Dallas. And, we thought it was a good time to invest. It was end of 2018. And looking at hindsight, if you bought a deal in 2018, closed your eyes, 2 years later, you could have sold it for a very good profit. But that deal, it still hasn't sold. We're still in it. And the business plan wasn't that, risky. It was just taking over the deal, burning off loss to lease, and just operating it effectively. But the problem is, as I got more into underwriting, more into the experience side, I started looking at all the red flags that came up. For instance, the property was it's in a Class C location. They've had to switch property managers at least twice now, and in terms of operations, and they've had continuous deferred maintenance where they never budgeted for that on the front end. I think the last distribution I received was back at the end of 2021 or beginning of 2022. Haven't received any distribution since. But all of that I can forgive. Deals go south, that's fine. But the one thing that I really regret is really kind of vetting the sponsor. I never really asked about their track record. I never asked about how their reporting goes. On Rise 48 side, we always do monthly reporting to the investors. We open up the entire financial book of business to the investors. So if they have questions about anything in the GL, anything in the property financials, they're free to ask us. They have all the information. The sponsor that we invested with, I think I get a report once a year on what's happening at the site, and mostly it's I would say one page of just jargon, and they don't really share the property level financials with us. And even when we reach out, it's very difficult to get a hold of them. So really the transparency and the communication is, I would say, very critical. And when you're investing, you're really kind of betting on the sponsor, not so much the deal, because a good sponsor can take a bad deal and make it a good one, and a bad sponsor can take a really great deal and make it a really horrible investment for everybody. So I would say, vetting the sponsor is very important.
Yeah, I must admit, I equally believe that I learn more from unfortunate bad experiences than some good ones, because I don't ever want to get burned a second time. And I remember, a little bit different, but parallel paths, back in 2007 when everything was humming, about a decade before you were talking about yours, I definitely bought a plot of land and was going to develop it. And, I base a little bit too much on emotions and renderings and the all the ritz and glamour of it, and then 12 months later, it was all a pipe dream. So
Yeah. I get
I
it.
got my investment back out of that one, but man, that was sure five tough years of sledding, of wishing and hoping, waiting for things to come back. So
Sure.
I'm glad you shared that and opened up about your experience. I know that makes at least me a stronger person in recognizing deal investments and underwriting them and analyzing them. And I'm glad you brought that personal experience into Rise 48 to do that with your professional career. All right.
Sure.
All right. Last question for you, if you don't mind. So I love to end with this question. What are your highs, lows, and what you have learned along your real estate journey to date?
Yeah, I think the highs on our end, Zach, Robert and I kind of make a really great team together where, we kind of complement our skill sets. And when we first got started, I had read a book called The E-Myth, where they kind of talk about how to kind of build a business. And one of the things in there was, develop like an org chart for the company and put the names of all the founders in there. So it's because that's where the company starts. And as you're growing the company, you're really kind of taking out your name or your partner's name and putting in an employee in that specific location and kind of building out the department from that perspective. And one thing that's been, a great thing for Rise 48 has been, Zach, Robert, and I really complement our skill sets where, we're not struggling to kind of be the best in the same area. So Zach, for instance, he's great at identifying capital partners, great at keeping up relationships with the brokers. I hate talking to people. That is
You're doing
not
a great job with me.
I'm a numbers guy. You give me an Excel sheet, I'll go audit that Excel sheet and underwrite a deal. That's where I live and thrive. And when it comes to construction side, Robert is great at visiting sites, seeing what looks good, what doesn't look good. I couldn't tell you if things look good on the property side. And Zach, for instance, he's more of a people guy, so he'll talk to the on-site staff. Robert's actually going to the units and kind of seeing how the work was done, right? So we kind of complement each other's skill sets very well. So that's been definitely been a very good high point of Rise 48, where we can kind of plug and play our different skill sets. I would say the low point for in the past has just been, just the market's been down and we've been doing variable rate loans that we have caps on, so we don't have any issues there. But just the market being down has been a low point for us in general. Just because we don't want to give the indication that there's something wrong at Rise 48. It's just, hey, market's down. We're going to continue operating. So we want to make sure that investors understand that. So we try to be as transparent as possible. And we get a lot of good feedback from investors. So we try to continue to improve our investor communication on that end. So I would say a low point is, continuing to be transparent in this environment and trying to open it up to investors as much as we can. And that's been really helpful to kind of keep our investor base strong in these times. But yeah, I would say those are the 2 points.
I love that. And I love transparency. I think people feel more comfortable, in people. I think the term in our industry is you invest with people like, and trust. And that transparency checks the boxes for being able to establish all three of those things.
Right. Yeah, I would say like in terms of, the multifamily market in general has just been kind of depressed. So it kind of brings everybody down. But like, because we've been able to buy deals in the current environment and continue to operate effectively, it kind of just speaks testaments that we can continue buying deals, with our equity partners because we're so transparent. So I would say the low point, just to reiterate, is just more of the market just being down is kind of bringing everybody down. But us shining through has been really good because we're staying as transparent as possible with our investors.
Yeah, I love that. Yeah, as a adult, I feel like I've been through two kind of low points in the economy, and I have all three times been very bullish on my real estate investments. And I'm realizing that this might be that third opportunity that I'm in right now. And I've been very bullish the same way because I've done so well the first two. So I appreciate you saying that. I think this is a great opportunity for those that have the ability to sift through and have that 3% rate, which is just mind boggling to me that you only take 3% of the deals that you underwrite and analyze. So thank you, Bikran, for taking the time out of your extremely busy schedule to join us today.
Of course.
And help listeners really understand more about real estate syndications, how to analyze an investment, and how those together combine to create passive rental income for investors. So thank you for your time.
Of course. No, thanks so much, Drew, for having me. And thanks for Starting Point Capital for having me on the podcast as well.
Yeah. And listeners, if you liked what you heard today, please leave us a 5-star review, share it with a friend, and find us on LinkedIn to start a conversation about how you can start your real estate journey for us. Again, I'm your host, Drew McWilliams, and thank you for listening.
Thank you for hanging out with us today and for listening to the Freedom Point podcast, powered by Starting Point Capital. This show is for entertainment purposes only. Nothing said on this show should be considered financial advice. Before making any financial decision, please consult with a professional. This show is copyrighted by the Freedom Point podcast. Written permissions must be granted before syndication or rebroadcasting. If you're interested in connecting, you can find contact information at startingpointcapital.com.